Interesting subject, pensions. A lot more to it than what you think. And actually, I've learned a few things myself in preparing for this webinar. So moving on. Who have we got? Well, today we've got Paul Davison and we've got Lewis Trevelyan.
Morning, everyone.
Morning, thanks, Lewis. I noticed that my picture's casting a shadow whilst Lewis isn't. Not quite sure why, but anyway. Moving on, that's us two. About PD tax, our vision is to enrich lives by making tax simple. Sounds good. And we don't do accounting. There's a phrase in the office which is, if an accountant can do it, then they should be doing it. What do? Well, we do tax advice, planning, specific tax advice, projects, etc., restructuring. We do a tax partner service for accountancy firms who don't really have a specialist tax advisor in their business. We do independent share valuations of limited companies, trading and investment companies for all different purposes. We do tax investigations and voluntary disclosures for people who are in trouble, not got it quite right. And we also do personal tax return forms as well, but they're mostly for people with sort of extraordinary situations. So this webinar is going to finish at 10 on the dot. Your mics are going to be disabled throughout the process, so you can talk, but we won't hear you. But what you can do is you can submit questions via the Q&A box or via the chat box. And towards the end of this webinar, the sort of last 7 or 8 minutes, Laura will ask us those questions and we can try and answer them for you. If your question isn't answered, don't worry, we'll contact you following the session to go through them. And the usual disclaimer, this presentation is for general information only and is not intended to constitute individual advice. It is recommended that you seek competent professional advice before taking any action. So now we're going to move on to the first part of the content, which is going to be done by Lewis.
Thank you for that, Paul. I will request control now.
Okay, I have approved.
Brilliant, thank you, Paul. So first of all, we will go through what a pension actually is. So a pension fund is essentially a money box into which you can make contributions, which you can draw on during retirement. You can make contributions to your own pension fund, and contributions can also be made by other people, such as your employer, or by a third party on the member's behalf, such as if you wanted to make contributions to your children's pension scheme, say. You generally obtain tax relief in respect of contributions to a registered pension scheme. However, contributions eligible for tax relief are restricted depending on the level of your earnings. And if your contributions exceed your annual allowance for the tax year, a charge to tax may arise on the excess, but this will be discussed in further detail by Paul later when he discusses the annual allowance charge. Now, with regards to why people use pension schemes, one of the main reasons is that any growth in registered pension schemes is completely tax-free. Therefore, the pension fund will not pay any income tax on any interest or dividend income, and it will not pay any capital gains tax on any capital gains received by the pension fund. So I'll try to change, there we go. So now we will discuss the different types of pensions. So most UK individuals, when they retire, will be entitled to some sort of state pension. The state pension is paid when individuals reach state pension age, which is currently 65, I believe. The amount of the state pension you receive is based on the number of qualifying years gained through paying national insurance contributions, and therefore some people are not entitled to receive a state pension. This state pension you receive is taxable income, and it is not taxed at source by the government. So aside from the state pension, the most common way people provide the retirement fund is by way of a personal pension scheme, which is offered by a financial organization such as a bank or maybe an insurance company. And as well as a personal pension scheme, a lot of you as employees may also be able to join your employer's occupational pension scheme if one is available to you. And I will discuss how contributions are made to these schemes in more detail shortly. So the maximum contributions to a pension fund that you can obtain tax relief for in any one tax year is 100% of your relevant earnings for that year. However, anybody can pay £3,600 per year into a pension scheme, regardless of their level of earnings. Now, you might be wondering what relevant earnings are, so you can work out how much pension contributions you can make in a year. So relevant earnings include all the income sources shown on the slide here, where it is worth noting that employment income includes the cash equivalent of any benefits received by your employer, such as company cars. And employment income also includes any taxable termination payments and share option gains you receive through your employer. In addition to this, if you have any self-employment income or profits from furnished holiday lettings, these are also relevant earnings for pension purposes. And the current guidance is that you can continue making pension contributions up to the age of 75 if you so wish. So why do people actually make pension contributions? So for pension schemes registered with HMRC, there are tax advantages for you and also your employer. So you receive a measure of tax relief when you make a contribution to a registered pension scheme, and this tax relief is generally obtained on pension contributions in one of two ways. So either by relief at source or under net pay arrangements. So first of all, relief at source applies where you make contributions to personal pension schemes. Under the relief at source rules, payments to a pension scheme are made net of 20% tax. So this means that, say, if you want £1,000 to go into your pension fund, you will actually only pay £800, and HMRC will make up the difference of £200. In addition to this, if you pay tax at the higher or additional rates, extra tax relief is given on your personal pension contributions by extending the basic and higher rate limits. So as shown at the bottom of the slide here, where a pension contribution is made, the original basic rate limit and higher rate limits are extended by the gross amount of the pension contribution. So this will be the amount you contributed multiplied by 100/80 to reflect the 20% tax. And this relief at source reduces your overall tax liability, as more tax will be paid at the lower rates of tax. So on the other hand, net pay arrangements apply to contributions you make to occupational pension schemes through your employer. So this relief works by the employer only subjecting your net pay to pay as you earn, therefore taking your gross pay and deducting the pension contribution before you are taxed on this amount. This means that the more you pay by way of the relief at source pension contribution, the less tax on your employment income will be charged under pay as you earn. However, it is worth noting that pension contributions do not receive relief from national insurance, so NICs are still calculated on your gross salary. The slide here summarizes how you receive relief from net pay arrangements, where, as you can see, pension contributions to an employer scheme are given as a deduction from your earnings. So we will now move on to the employer side of things. So if your employer makes a contribution to your pension scheme, this is a tax-free benefit. And so you will generally pay no tax on this pension contribution received by your employer. However, employer pension contributions do need to be considered for the purposes of the annual allowance and lifetime allowance, which will be discussed by Paul later on this webinar. So in addition to this, employer contributions to an employee's pension scheme will be deductible expenses for the purpose of calculating the taxable profits for the employer's business, as long as the contributions are wholly and exclusively for the purpose of the trade. So retirement benefits. So as of right now, once you reach the age of 55, you are entitled to draw benefits from the pension fund in any way you choose. Tax should be deducted at source from taxable payments by the pension provider, and you should receive a P60 or a tax certificate detailing this after the end of each tax year. The total amount you can take as a tax-free lump sum is restricted to 25% of the lifetime allowance, which is currently £1 million, £73,100. So there are a variety of options on how you can withdraw funds for your retirement, and I will discuss some of the more popular ones now. However, nothing is stopping you from choosing to leave your pension pot untouched initially. And by delaying taking a pension until a later date, the pot will continue to grow tax-free. So this potentially provides more income once the pension funds are eventually taken. Although, if you've decided that you do want to draw from your pension, the first option is that the pension fund could be closed and you could take the whole amount as cash. In this case, the first 25% of the amount taken will be tax-free, and the rest should be taxed as non-savings income at 20%, 40%, or 45%, depending on if you're a basic, higher, or additional rate taxpayer. This option is likely to create a large tax liability in the year the fund is taken. So another option could be to use a pot to buy an annuity, such that up to 25% of the pot can be taken as a one-off tax-free lump sum, with the remainder of the fund then converted into an annuity, which provides a guaranteed income each year. The income from the annuity is also taxable as non-savings income. Just so you know, we don't have time today, but there are also potential other ways of drawing from your pension, and most pension providers will allow individuals to adopt various combinations of the pension withdrawal methods. So I believe it should be now time to move on to the poll. So Paul, if you would be able to launch the poll. So the poll today is, so do you know what the current standard annual allowance, i.e. the most you can save in your pension pot in a tax year before you have to pay tax is? So the options are, so we've got A, £30,000, B, £40,000, C, £50,000, and D, £60,000. So I'll just give you a few moments now to answer that. So it looks like we have the majority of the answers in, and 88% of people have correctly identified that the current annual allowance is £40,000. And I believe HMRC have said this will be the amount until at least 2026. So this should be around for a while. So I'll stop sharing that now. And I will now pass over to you, Paul, to continue with the webinar.
Thanks, Lewis. Excellent. Okay, lifetime allowance. It's a lifetime limit on the level of tax privileged benefits from your pension scheme. As Lewis mentioned, it's just over £1 million. And the key test here is the benefit crystallization event. So that's interesting. So what is a BCE? Well, the BCEs are either when you retire or when money is drawn from pension, whichever comes first. Benefit crystallization events, effectively, in terms of retirement, there's a lot of them. And they're all listed in FA 2004, section 216, if you want to look at them, because retirement's not quite as straightforward as it used to be. But if you think about it, if you had £1.5 million in your pension scheme when you retired, and that means that actually £1,073,000 of that is going to be in the authorised pot, and the balance of just over £400,000 is going to be in the unauthorised pot. So what does that mean? Well, that means that you've two choices really. If it's unauthorised, you can strip it out of the pension scheme, pay it to yourself. It's going to cost you 55%. That sort of accounts for the sort of the tax-free growth over the period and for getting money out of the pension scheme. You can decide to leave it in the pension scheme as normal, but if you do that, once you've retired, you do have to pay a 25% charge. So that money will stay in the pension scheme, but you've got to pay 25% of the unauthorised pot. Pension scheme can pay that, but it is like a one-off charge to the scheme. And then when you do take any money out of the unauthorised pot, it's treated as being your normal income, normal income tax at 20%, 40%, etc. At your marginal rate. That's the way the lifetime allowance works, in effect. It's not straightforward, but that's roughly how it works. The annual allowance, which Lewis mentioned earlier, a bit more straightforward, although there's quite some complications with this. Basically, it's £40,000 a year, and that's the most you can save into your pension pot in a tax efficient manner. It's not the most you can put in. You can put as much as you want into a pension scheme in a particular year, but anything above the annual allowance, it's going to be a charge to your pension scheme, a tax charge to your pension scheme based on the amount you've paid in above the pension scheme, above the annual allowance. That tax charge is sometimes payable by the pension scheme, sometimes payable by yourself. It depends on the situation, really. That covers, so the £40,000, well, the annual allowance covers gross contributions to a defined benefit scheme and any increase in a defined benefit scheme in a tax year. The second part there, increases to defined benefit schemes in a tax year, can be complicated. We know people like doctors, those sort of people have those types of issues, and it's not something we're going into a lot of detail today, but we're happy to help you with that if it's an issue. The annual allowance, you can carry over an annual allowance if it's not used from the previous 3 tax years. If you have unused annual allowance from more than 1 year, you need to use them in the earliest to the more recent. So as an example, if somebody had not paid anything ever into a pension scheme and they paid £50,000 in the 2022-23 tax year, which is where we are now, the way that would be set off, obviously it's £50,000, so it's £10,000 more than the annual allowance. You set the first £40,000 off against the current annual allowance, 2022-23, and then the balance £10,000 will go against the 1920 tax year, which means then going into the 23-24 tax year, you're going to have 2020-21 to carry forward, 2021-22 to carry forward, and that particular year as well. No claim needs to be made for a carry forward, but it is important to keep records in case HMRC come inquiring. Pension planning for business owners, just in general, really. People with companies, they might build up a bit of cash if they've been successful in the company. Perhaps they've never used the pension scheme because they don't really like them, they don't understand them. But it actually could be a way of sort of getting money out of a company for people in the late 40s, early 50s, are coming up towards retirement age, which is 55 for personal pension schemes. Because we know that we can get tax relief for going in. We can get 25% of the cash out tax free on retirement. So that's great. With the balance taken at marginal rate, and obviously it avoids national insurance as well. So it's a good way of sort of circulating money out of a company for people who have not used it. Another thing to think about is whether you can balance up pension contributions for spouses, because obviously if in retirement one spouse has a significant income and the other one has very little income, then the person with very little income, effectively you're wasting their personal allowances and basic rate band, whereas the other person might be into the higher rate bracket, and so it's worth trying to balance it up if you can. Pensions and property, yeah, it's relatively well understood, but I'm just going to mention it. Obviously, stocking a pension, SIP or SAS with cash, you can use that money to buy property, a commercial property only. And the SIP or the SAS can gear up by £1 for every £2 in the fund. So if I had £200,000 in the fund, you can borrow £100,000, giving you £300,000 to buy a property. That £300,000 doesn't have to buy a whole property. You can buy a percentage of a property, with the balance being acquired by an individual or your investment company or however. And then we know that obviously the pension rents the property to the trading company, we get rent out tax efficiently, blah, blah, blah. But there is something to bear in mind. It's not all roses, because sometimes people get a bit fed up with the sort of pension trustees because the charges can be quite high and there's a lot of them, and it can be quite difficult in terms of charges. So that's something to bear in mind if you're advising your client. It's not as straightforward as you think. Pensions and inheritance tax. So when an individual dies, the pension scheme is actually, it's not actually an asset of theirs personally, it's actually in a trust. So what that means is it's not, generally speaking, subject to an inheritance tax because it's not in their taxable estate, which is brilliant news. So, pension schemes are a good way of moving assets down to the next generation. Pensions aren't covered by a normal will. So normally it's important for a letter of wishes or directions to be signed to direct the pension company as to who's going to become the beneficiary of the pension scheme when that person dies. It's something to bear in mind. And this is another tricky area, really, and I've put a lot of caveats there because it's an area where we're sort of going into the world of where a financial advisor might advise, but effectively once an individual's died and the pension scheme moves to the beneficiaries, what happens? Well, if the person who's died is 75 or less, the treatment can be quite beneficial. Effectively, it's possible for the beneficiaries to get the money out of the pension scheme as a lump sum and pay no further tax, which is a real bonus. If that person dies after 75, then the money can carry on in the pension scheme, but for the beneficiaries to get it out, they've got to pay tax at the marginal rate. But as I said, this is a tricky area. There's a lot of different options around this. It's something to think through thoroughly with an IFA and your client. So it's almost 5 to, so that's flown by. Every client's got different circumstances, so call us if you've got any situations to discuss. We're happy to help. The next seminar date to be announced. Date's actually going to be the 1st of December. We know that now, and that's an employment law and taxes webinar with LCF Law. So sort of IR35, agency, that type of stuff, holiday pay. That's the 1st of December. Questions, Laura? We got 5 minutes, I think, for questions. Do we have any? Are you there?
Yeah. Yep. So the first one is, can I just confirm that contributions to the annual allowance include employer and personal contributions?
I'll take this one, Paul. So yes, that is right. The annual allowance is the total amount of contributions that can be paid into all pensions for an individual before a tax charge applies. So this allowance applies to all individual contributions, employer contributions, and contributions for the individual paid by a third party. So hopefully that clarifies your question.
Great, thanks, Liz. The second question we have is, if there is no letter of wishes for a pension, who is the default beneficiary of a pension?
Good question. I don't know his answer. Do you know, Lewis?
Can't say I'm sure about that one. Might have to go away and have a look.
It's an interesting question. It's more of a sort of a legal question than a tax question. But yeah, we can find out for the person who's asked the question. I know when I've done my pension schemes in the past, there's been a form to fill out in terms of directing the pension trustees as to who the beneficiaries will be. I think it's quite a standard thing to do, complete that form at the start of setting up your scheme, but obviously it might not happen. But yeah, whoever's asked that question, we'll find out and get back to you.
Great. Another question we have is, can a self-invested personal pension own a residential property?
The answer is definitively no. It cannot. 100%. It can own commercial property, but it can't own residential property. I think there's a list. There's some rules about what a personal pension can and can't own. Can't tell you exactly where the list is, but I have looked at the list before, and I'm 100% sure that it cannot own a residential property.
I think the last question we have is carry forward only possible from previous tax years if you've been a member in the previous tax years?
That's a good question. I think that is true. I'm sure that's true. Yeah, you have to have the pension scheme in place to operate the carry forward. Yeah, 100% sure about that. So I mean, I think people sometimes, when it comes to it, obviously if somebody's not made any pension contributions for a while, and then you decide to talk to them about contributions, and then they go, "Oh, well, I've never made any contributions in the past. It's a bit of a red light." You have to go back and see whether they had any pension schemes when their first employer, back in the 1990s, whatever, or the 1980s, or the 1970s, depending on how old you are. But yeah, that's a good point. You do need to have a pension scheme to operate the carry forward.
That's great. I think we've got through all of the questions.
Okay, great. Are we having a breakout period? Yes, let's have a breakout period. I do need to crack on actually, but we'll have a breakout period. So people who want to stay on the line to ask a question or just to chat, just stay on the line now, and we'll enable your mics in a couple of minutes. If you've don't want to join the breakout group, just thanks very much for attending, and hope you have a nice day and that you've learned something today. Thanks very much. Cheers. All right, we've got some people who have stayed on, some familiar names. So I'll allow you all to talk. We've got 10 minutes for the breakout. Hello, Kim, Ian, Lindsay, Patrick, Ramsey, and Ryan. Any questions from the breakout team? Hello, is that Kim?
Yeah, it says hi. You all right?
Hi, Kim. Nice to speak to you.
Yes, you too. Thank you for that. That was really useful.
Good.
And sorry, that was me with the question about the letter of wishes as well.
That was it.
Sorry.
that hand grenade.
Yeah, sorry about that. Yeah, I just think it was just when you said it, and I thought, God, I wonder if I've got any clients who haven't done the letter of wishes. But then from what you said,
it's a very important point, isn't it? I mean,
yeah, but it sounds like
it
probably is done as a matter of course, isn't it, by the pension providers? But yeah, I just wondered.
It is, but it's one of those things where you sort of do it at the time, and you sort of in your 20s or 30s or 40s, whatever. You don't even think about it, do you? You don't take it very seriously.
Yeah.
And things do change, don't they? You know, situations change.
Yeah, it made me think about my own, and I was sitting there thinking, oh, have I done that? I don't remember, but I think I have, but I'm going to check.
I wasn't sure whether the rules on intestacy would apply.
Yeah.
You know, there's a rules in, but then again, I don't know if they would because it's not the rules on intestacy apply to your own personal assets.
Yeah.
Whereas the pension scheme is not your personal asset. So
yeah,
it's a good question.
What happens? Don't know. I've got another question as well. Just on when you've got a limited company with, say, one director or husband and wife directors, and so they're only paying themselves the lower salary, you know, kind of tax efficient salary. So say they're paying 12.5 grand salary. What's the limit then that the employer can contribute from the limited company in the year? Is it limited to the 12,500 salary, or can they put more in?
One for you, Lewis, or do you want me to do it? It's up to you.
Might be one for you, Paul, I think.
Are you sure?
Yeah.
Okay, the answer is that you can pay what you want, effectively. Because effectively it's part of, so it's a limited company that's employing an individual.
Yeah.
The payment to the pension scheme by the limited company is effectively forms part of their remuneration.
Yeah.
So it's not limited. It's not limited by what the individual puts in, what the individual earns.
So the relevant earnings thing doesn't apply in that case.
That's right. That's only in respect of personal contributions.
Right. Okay. Yeah.
So a limited company, an entrepreneurial limited company could pay the shareholder director 50 grand, you know, only in pension contributions.
Yeah.
If they wanted to.
Right. Okay.
Subject to all the other rules, but yeah, that's definitely the case. Or I wouldn't be able to do it.
Yeah, I know. Well, that's what I was thinking, because it does come up sometimes, and I always end up kind of going around in circles thinking, does the 40k, does the relevant earnings apply? And I kind of think, I don't think it does, but I'm never quite sure why. But yeah, that makes sense. Thank you.
Does that help?
Yeah, it does. Yeah, thanks.
Cool. We've got Ian and Ramsey on. Any questions from Ian and Ramsey at all, chaps? We're just here to listen. It's up to you guys. If you want to ask a question, Ian or Ramsey, you probably just need to enable your mic and let us know. No? Okay. Perhaps I left their webinar on without switching it off. Did you find that useful, Kim? Hello, Kim. Hello, Kim. Hello, Kim.
Hi, sorry.
Did you find that useful? Anything else you want to?
Yeah,
talk
no,
about
that
or
was
discuss?
really useful. Thank you. Just a good kind of whiz through it. Yeah, just kind of.
I think the lifetime allowance is quite a complicated thing. The lifetime allowance, that's
yeah,
a tricky thing to understand.
yeah, it is with the what happens at that point. Yeah.
Also, what happens when somebody dies and what happens to the pension scheme when somebody dies is something I probably am not quite as sharp as what I should be really on it.
Yeah. Yeah, it's quite complicated, isn't it? There's lots of ifs. You feel like you need to kind of go back to school and do a tree diagram or something.
Yeah, that's right. And I think
if this, it's that. If that, it's this.
That's why I've never sort of looked at it in much detail, because I just think, oh crikey, it's complicated, and
Yeah,
it seems to be an area that an IFA would do. So
yeah,
I've sort of
yeah,
tried away from it a bit. It is. Anyway, thanks very much.
Yeah, that's great. Thank you.
Stop it there, and have a nice day, Kim.
Yeah, you too.
Cheers,
Thanks again.
Kim. See you later.
Bye.
Bye.